You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mikey Hu. Hey, what's up, Market Moose? Mike from The Moose on the Loose. I hope you are doing well on this Tuesday. So let me ask a quick question. Which Canadian stock has been trading at its all-time high seems like forever? A stock that shows over 50% total return year to date, over 165% total return over the past 3 years, and a total return of 205% over the past 5 years. So literally being trading at its all-time high every year for the past 5 years, and still shows an interesting entry point. Like, not a crazy entry point, of course, but an interesting one. And this name is Dollarama. I got that question last week about my thoughts on Dollarama, and I thought it was quite interesting because I recently highlighted it for my Dividend Stocks Rock member as one of my favorite stocks for 2025. So how is it possible that a business that keeps on trading at such a relatively high P ratio, we can say right now the current P ratio is at like 37, the forward P is at 32, 33, so definitely expensive, especially to buy some cheap stuff, right? So very expensive stock. And I'm still telling you that it's probably a good buy right now. And I'm actually debating if I should add it to my portfolio. And I know, kind of crazy. I'm not a big fan of valuation, but two things that I look at is usually the dividend yield versus the average of the past 5 years. So in this case, we have a dividend yield of about 20.25% versus an average over the past 5 years of around 0.30. So definitely trading a little bit under, so definitely not a deal there. And in terms of the P ratio, which is the second thing that I look at in terms of valuation, is the forward P, which in this case is close to 33 times earnings versus the average of the past 5 years. And again, we are trading around 30.5, so slightly above again. So in the both cases, we are in a situation that it's not greatly overvalued, but definitely you do not have a deal if you buy Dollarama today. So why in the world I'm telling you that it's probably a good entry point? Well, because I base my investment decisions on a lot more than looking at valuation. Of course, the best timing to buy Dollarama was last year, 2 years, 5 years, 10 years ago, but it would have been very hard to know that, right? So between 2018 and 2021, the stock did not move much. I mean, it dropped during the COVID, but I mean, at the end of 2017, the stock was trading around $50, and at the beginning of 2021, we were still at $50, sorry. So $50 for like 1, 2, 3, about 3 years, and then it started to ramp up. What happened at that point? Well, the thing is, when you look at the dividend triangle, you get the story. Starting in 2021, 2020, we started to see a big jump in revenue. So we went from roughly like a little bit less than 4 billion in sales before 2020 to now like above 6 billion right now, and on target to keep on growing. What's the most fascinating point when you look at the dividend triangle that we have at Dividend Stocks Rock is I can see how earnings per share are moving according to the revenue. So I see the revenue trend, and then right below that I see the earnings per share trend. So I can see that the company is actually able to increase its margin on top of growing its revenue. And it's usually sometimes it's the opposite, because you have to like boost revenue by spending more on marketing, or you hire more sales reps. So your expenses are growing as fast as revenue or sometimes faster. But in this case, it's the opposite. The 5-year annualized growth rate for revenue is almost 11%, but for the earnings per share, we are at 16.5. And then for those who are going to tell me, but Mike, it's not really a dividend paying stocks at 0.25% yield. Fair enough. You are right. But the dividend has increased at an annualized compounded rate of 12% in the past 5 years. So doubling faster than every like 6 years or so. So yes, it is very small, but the payout ratios are below 10%. The business is actually making the choice of allocating its capital towards growth. And this is where I think there's a value to pay for quality, is when you see such great company with a lot of growth, a lot of profit, and then management is literally telling you, oh, we're not going to pay you a dividend right now, like not a juicy one anyway, mostly because we find other ways to generate value for shareholders. And I kind of like that, especially because the company is not done opening new stores. So two things that I like from Dollarama is right now they grow by opening new stores across Canada, which is great, but they also grow organically. So the comparable store sales is increasing. So last quarter, we're talking about like roughly like a 5% comparable store sales increase. So that is when you look at last year's same store, and you look at this year, the same store for the sales are increasing. So it means that each store is finding ways to either sell more stuff to their clients or attract more clients that buy more stuff. So that is great to be able to grow by opening new stores, but also to see that the current stores are actually quite healthy. So they're not done saturating the market, which is definitely a good thing. The other growth vectors I see, it's the participation in Dollar City, that is opening new stores, doing exactly the same playbook in Central America, such as like El Salvador and Guatemala. So a pretty smart way, because of course we are targeting people that will make like small expenses in countries that are developing. So a great playbook to open over there. Seems to have like a similar trend than what we see at Dollarama as well. So that's another way to grow sales and grow profit in the coming years. So that is telling me that the dividend triangle I see right now is likely going to repeat itself for several more years moving forward. The other thing is, as you know, I'm a bit concerned about the Canadian economy. The stats are not that great. We have higher unemployment rate. We know that consumers are strapped with their budget. The interest rates have been going down in 24, but probably not enough to like save all consumers from their debt. So all the mortgage renewal will likely be still higher than what they had like 3-4 years ago. And that could cause another shock on the Canadian economy, which is not growing that fast these days. One thing is for sure is if you are tight on your budget, well, the place that you're going to go to shop for like basic needs and stuff will likely be a dollar store. So it's like one more reason to think that even if we have a tough year in 25, even if we eventually enter into a recession, chances are a good place to put a $2 investment would be a company like Dollarama. So yes, there is no deal here, but I think that for the long run, if you're thinking in decades, that's probably an interesting play, especially if you are willing to hold this one for a very long run. Well, as I said in the introduction, the 5-year total return is above 200%, which is not too bad comparing to the rest of the market, right? If you want to have more ideas like this, I actually did a complete review sector by sector, providing all my new ideas at Dividend Stocks Rock. And this week is your last chance to lock up a huge deal. So I increased my price about 2 weeks ago. So the regular membership is at $247. The pro membership is at $497 now. But for one last time, you can get it at $267 for DSR Pro. So that's a 46% rebate. It's never going to come back in 2025. That discount will be gone, buried, and you can forget about it. So if you want to benefit from this huge deal, one last time, you go to dividendstocksrock.com/last-chance. So last chance, dividendstocksrock.com/last-chance. And there you go. You'll be able to benefit and lock in this very deep discounted price forever, because you keep that price as long as you stay a member, which is also a pretty good deal. So, right, Moose, that's enough for today. We're going to talk again tomorrow. And until then, don't forget to stay invested. Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.